kind of like we're doing today, to help when we can. And all of our advice and trainings are always free of charge to families. So what we're going to go over today are all of the federal loan repayment options. So I'm not going to touch on the newest one that has not been finalized yet, because I've heard mixed things as to whether that's going to actually be killed before it becomes live. So I didn't want to go into too much detail because it's not active right now. So I'm just going to be going into all of the options that are currently available for students. We're going to go into deep details about the income-driven repayment plans, because those have some really detailed information on them, onto how you can qualify them and what the benefits of each of them are. There's some nuances to each of those plans. Then we're going to talk about public service loan forgiveness and how those work in conjunction with the income-driven repayment plans, and what that looks like for students who may be able to take advantage of that. And at the end, I've also have some resources for you. Particularly NASFA recently put out a great toolkit for students who are re-entering repayment after the payment pause. And there are some great infographics there, short videos, and I'm just going to share that with you. You may have already seen those, but I thought it was worth pointing out. They're great to share with students about going into repayment, and it helps them step by step through the process. So first, federal direct loan repayment options. So how it works normally, the payment pause kind of changed this whole process and pushed out all of this for a period of time where everything is not accruing interest and payments aren't due. So it also makes exit counseling very difficult right now, because there aren't any real concrete dates that you can tell students this is when you're going to enter repayment. But in a normal world, which hopefully we'll be going back to soon, what would happen is once a student graduates or leaves school, 6 months after that period, the student graduates or ceases enrollment, they would begin repayment. So they have a 6-month grace period, and then they would start repayment. And normally during that grace period, that's when the student would choose their repayment option. If they don't choose another repayment option, they go into standard repayment. And what standard repayment is, we'll go over in the next slide. But basically, they take the whole amount that the student has borrowed and divide that over 10 years of monthly payments, so 120 payments, and that becomes what the loan repayment is for the student. They also have the option to choose graduate repayment, extended repayment, or income-driven repayment. We'll be going over exactly what all it is. So again, standard repayment is usually the least expensive option over time, because students are paying that over 10 years. Most of the other options are extending the payment over a longer period of time, so more interest is accruing, and it becomes more expensive over time. But it may be more expensive to begin with for a student to be in the monthly payment. For their monthly payment may be more, because it's just taking that lump sum and dividing it into 120 payments. So again, they are eligible for PSLF, public service loan forgiveness, with standard repayment, but if they make all of their payments over 10 years, there's going to be nothing left to forgive over standard repayment. So even though technically it is one of the options available with PSLF, it is, if they just do standard repayment, there won't be anything left to forgive. But if they're at some point in standard repayment in conjunction with some other income-based repayment plans that have extended to over 10 years, those standard payments will qualify towards PSLF, and we'll go into more about what PSLF is later on.
Sean, can I just interrupt you real quick?
Yep.
So I just wanted to point out these graphics that are on each of these slides. Our marketing team worked with Sean to create these little graphics that you might find helpful if you wanted to do a presentation for students. we tried to make this visually just a little less complicated. So, you can use this presentation if you want it, just let us know. We thought it would be a good way to kind of explain these things that you could even use beyond today. So just let us know. I think Sean did a really good job with our marketing team on this, because it was very bullet heavy and very wordy. And I think this makes it a little bit simpler. So.
Yeah, when I was first going over all of this, especially once we get into the income-driven repayment plans, there were just a lot of bullets and a lot of language, and it was just overwhelming. So we have a wonderful marketing person who just is really great at visualizing things. So she helped distill it into these graphics. So hopefully they'll be helpful. You'll see along the bottom, it's going to tell you exactly which types of loans are eligible for each of these repayment plans. So standard repayment is available for all types of federal loans, but for graduating repayment, you see direct and FEL loans. So older loans that students may have had under the FEL program are also eligible for graduate repayment, standard repayment. So that shows the type. Then it's going to show you the length of time for the payments, and then you'll see that one where it says available upon request. There are some qualifying criteria that students have to meet to get into certain programs that you'll see later on, but for graduated and for standard, that's just available upon request. You'll see graduated is not eligible for public service loan forgiveness. And then any additional information is in that last box. So how graduated repayment works is it starts off with lower payments at the beginning, and then it steps up over time. So at the beginning of the payment period, they start with lower payments, and then over 10 years, it gradually goes up and up. This is going to be more expensive for students in the end than standard, because more interest is accruing at the beginning because they're making smaller payments. So the principal isn't being reduced at the same rate as standard. So it's still 10 years, but it does become a more expensive option. But it may be a good option for students that are in a career that starts off at a lower pay and then gets larger over time. It's more affordable for students. And I want to talk a little bit about federal loan consolidation, because some of these repayment plans will require the loans to be consolidated in order to qualify for them. For example, if you have a FEL loan, an earlier family loan through the FEL program, then you can consolidate that to become a direct consolidation loan, and then they become eligible for this. Also, if you have a Perkins loan, those can be consolidated as well with the direct student loans to become a direct consolidation loan to make them eligible for these different income-based repayment plans. So once you combine all of those loans into the direct consolidation loan, and you can select which of the loans in your portfolio you want to consolidate, then they become a fixed interest rate. It's a weighted average of all the rates on the loans being consolidated. So they take a weighted average of all of those. They add a small percentage to that. It's less than 1%, and that becomes a fixed rate for all of those loans. And the loans have to be in repayment or grace period in order to consolidate. So you cannot consolidate while you're in school period. You have to be either in repayment or grace period. You can't be in a default situation for consolidation either. And unless you're trying to get that rehabilitated, then there are certain ways that you can do that. And then once you are consolidated, all of these repayment options become available to you. And then the repayment term is 10 to 30 years based on the repayment plan that you choose, which we're going to be going over. A student cannot consolidate a PLUS loan that was borrowed by the parent. So just so students are aware, they can't take a PLUS loan that the parents borrowed and make that their own loan through consolidation. They can consolidate a grad PLUS loan, but not a parent PLUS loan. You cannot consolidate private loans. Students sometimes think that they can take a private loan and consolidate that into a federal loan. that is not an option. Students can refi through a private lender. That's a different process, but consolidation is only for federal loans. And you do that whole process on studentaid.gov. There's no application fee for that, so there are no additional fees that students have to pay in order to consolidate. And once you consolidate that, all of those loans become one loan. You cannot undo the consolidation. It is a new loan once you've gone through the consolidation process. So factors to consider: you do receive then one bill per month once you consolidate those. So you might have potentially lower monthly payments if you are making, for example, if you had a Perkins loan and you had a minimum monthly payment on that of $50 to $100, and then you were able to consolidate that in with your other loans, then it becomes one payment. And if you're doing that income-based repayment plan, or you're doing one of the other plans, that's all lumped in with one loan and becomes one payment now. So it could be potentially lower for the student. For loans like the Perkins loans that aren't eligible for these alternative loan repayment plans, you then can become eligible for that. For FFEL loans that aren't eligible for these income-based repayment plans, that can make them become eligible. And if you had a variable rate loan under one of these federal loan programs, there used to be some variable rate loans at some points, then it becomes a fixed interest loan. And you do lose the borrower benefits with the original loans. For example, for Perkins loans, for students that are in certain nursing programs, that they have nursing forgiveness with the Perkins loan, once it's consolidated into a direct loan, they're going to be losing those benefits. So make sure that students are aware that if they do have any kind of forgiveness benefits with the loan that they are consolidating, to make sure that the new loan has those benefits as well, and that they're not going to be losing on that. And if you do increase the length of your repayment, it is going to be a larger total cost of the loan over time, but it may lower your monthly payments. So let's go into the income-driven repayment options. Okay, so how income-driven works is they consider what your income is at the time. So you will have to report your income yearly in order to qualify for these plans and to come up with what your monthly payment will be. And depending on which option you'll select, you'll pay between 10 to 20% of the discretionary income on that. Some plans require that you qualify with a partial financial hardship. I'll be going over what that is in just a minute. And the different plans are income contingent repayment, income-based repayment, which is IBR, pay as you earn, which is pay, and revised pay as you earn, which is called repay. So how do they measure discretionary income? So unfortunately, it's not the same for all of the different payment plans, but for IBR, pay as you earn, and repay, they take your annual income, they subtract 150% of the federal poverty guide, and that becomes your discretionary income. And then depending on which of the plans, and we'll be talking about the details of this, they take a certain percentage of that discretionary income, and that becomes your payment amount. Now for ICR, that one, the discretionary income is going to be a little bit larger because they're taking your annual income and they're only subtracting 100% of the federal poverty guide, and that becomes your discretionary income. So your discretionary income under ICR is a bigger pool when they take the percentage than under IBR, pay as you earn, and repay. And for some of the plans, you have to have what they call a partial financial hardship to qualify for that. You do need that for certain plans when you first enter the plan, but you don't have to continue to show the partial financial hardship to continue in most of the plans. But you do have to show that in order to qualify initially for the plan. So under IBR, what the partial financial hardship qualifications are is that the amount due on the standard repayment plan is greater than 15% of the difference between your AGI and 150% of the poverty line for your family size in the state you live. So if you meet that qualification, then you meet partial financial hardship. And basically, so what that means is that your 15% of your AGI minus the 150% of the poverty line is actually what your IBR payment is. So basically, if your first IBR payment is less than standard repayment, then you're showing partial financial hardship. So for pay as you earn, it's again, the standard repayment is greater than 10% of the difference between your AGI and 100% of the poverty line for the family size in the state that you live in, which again would be what the pay as you earn payment would be when you first start. Does that make sense? Okay. So now we'll start going over the different plans. I see a few questions here. I just want to make sure that everything's okay before I start getting into the income repayment program. So first, we're going to talk about ICR. Now, payments are calculated based on the lesser of 20% of your discretionary income. And remember, the discretionary income for ICR we described earlier is different than IBR and pay as you earn, or what you would pay on a repayment plan with a fixed payment over the course of the years, adjusted according to your income. So you have to have a direct loan in order to qualify for this. FFEL loans do not qualify for this. Again, you can consolidate your FFEL loans into a direct consolidation loan to qualify for this. Then you pay those income contingent repayment amounts up to 25 years. Once you make 25 years of payments on this program, anything remaining after that is forgiven. So this is not public service loan forgiveness. This is just ICR. You make 25 years of payments and that is forgiven. Any remaining balance that is forgiven is a taxable event, so that will show as income for the student in the year that they receive the forgiveness. There is no income threshold for eligibility for this. So you do not have to show any type of partial financial hardship to qualify for this. It's eligible for PSLF, so we'll go over what PSLF is later, but if you are on this plan, you can qualify for PSLF payments, so that if you make 10 years of payments while you're on this plan and doing eligible service, I'll go over that more later, then that's forgiven over 10 years rather than 25 years with PSLF. There's no cap on the payment amount, so that can just keep going according to what your income is. So if you stay in that program, your payment may actually be larger at some point than standard repayment may have been if your income goes high enough. And income is verified annually, and then a new amount is calculated on that. For one of the criteria of this program is capitalized interest can't exceed 10% of the amount of the loan at the time the loan entered the repayment plan. So after this, interest accrues but does not capitalize. So that is one of the benefits of this program. We'll go on to the next one. So income-based repayment, and just to complicate a little bit more, there are two different income-based repayment plans, one for borrowers who had loans before 7/1/2014, and there's one for loans after 2014, and they're just a little bit different. And the IBR for students before 7/1/2014 is available to students both who have direct and FFEL loans. So this is one of the few of the income-based repayment plans that is available for FFEL loans. And again, they pay for 25 years, and then after they make those 25 years of payments, if there's any balance left on the loan, then it is forgiven. And I didn't mention this on the last slide, but if the payment amount that the student is making is large enough that it's paid off before 25 years, then that is often the case, and students don't actually make it to the 25 years and receive the forgiveness. So it may actually be paid off in 12 years, 15 years, 18 years. It all depends on what the student's loan balance was and how large their payments are. So for each student, that payment period may actually be less than 25 years, but 25 years is the maximum amount of time that they will be paying on that loan, and then they will receive forgiveness after that. You do have to show partial financial hardship to enter this plan, but again, you don't need to maintain it to remain in the plan. So as long as you do your paperwork each year and show your income every year and remain in the plan, because if you don't renew every year and send in your tax returns to your servicer, then they bump you out of the income-based repayment plan and put you back into standard. So that is one of the caveats to make sure that you share with students that they do have to be diligent about this and make sure that they get that paperwork in yearly with their income. It is eligible for PSLF, and the payment is 15% of the discretionary income. And that's based on the family income if married and filing jointly. If you're married and filing separately under IBR, it's only going to look at your income, not the family income. But if you are filing jointly, it's going to look at both. And this one is actually capped at what the standard 10-year repayment plan would be. So it doesn't keep going up with your income. If you do hit the amount that your standard repayment would be, that would become your IBR payment, then the standard repayment. And there is no limit on interest capitalization for this one, like the last plan. And let's see, IBR for students who borrowed after 7/1/2014. The difference with this one is FFEL loans are not eligible for this. And this one is 20 years rather than 25 years. So the payment period is a little bit shorter before you get that forgiveness factor. You do, again, have to show partial financial hardship to enter the program, but don't need to stay in that partial financial hardship every year. It again is eligible for PSLF, and the discretionary income is the same, 10%, and it's again based on family income if you're filing jointly, and just your own income if you're filing separately or not married, and then capped again at the 10-year standard repayment plan. And you do have to always reapply every year, and well, not reapply, but you have to show your income to them every year by showing your W-2s to them every year. And there is no limit to the interest capitalization again under this program. Okay, and now pay as you earn. And to qualify for pay as you earn, you must be a new borrower on or after October 1st, 2007, and have a loan disbursement on or after October 1st of 2011. You could not have borrowed a federal loan, a federal student loan before October 1st of 2007, and you have to have received a newer loan after 2011 in order to qualify for pay as you earn. FFEL loans are not eligible for pay as you earn, but again, you can consolidate any FFEL loan into a direct consolidation loan in order to qualify for that. You pay the amounts for up to 20 years, and then again after that, the remaining balance is forgiven and is taxable. You must show, again, partial financial hardship to enter this plan. You don't need to maintain it every year to stay in the plan. It is eligible for public service loan forgiveness. And for this one, the payment is 10% of your discretionary income. Remember, the discretionary income for pay as you earn is a little bit different than for ICR. It's a little bit smaller. And it's based on your family income if married and filing jointly. If you're filing separately, again, it's not going to look at the spouse's income. And it's capped again at what 10 years of standard repayment would have been. And you do have to show your income annually so that they can calculate that new repayment amount, because each year they're going to change that repayment amount based on your new income. And capitalized interest on this can't exceed 10% of the amount of the loan at the time the loan entered the plan. After this, interest accrues but does not capitalize. Okay, now repay. This one does not have additional criteria to qualify. So as long as you have a direct loan, you can enter the repay program upon request. If you have a FFEL loan, you do have to have that consolidated. And then this one, you have to pay up to 25 years, unlike pay, which was 20, after which any remaining balance is forgiven and is taxable. You do not need partial financial hardship to qualify for repay. So you don't have to show that in order to get into this program. It is eligible for PSLF, and payment is 10% of your discretionary income. On this one, your spouse's income is included regardless of if you're filing jointly or if you're filing separately. So they're always going to be looking at your spouse's income if you are married. That is one of the differences with repay, that for married students, they're going to look at both incomes regardless of how you're filing. And this was a big thing at the medical school that students would look at when they're planning to get married, and looking at the different incomes, and they were really concerned about whose income are they looking at for these plans. And the income, again, is verified annually, and the new repayment amount is calculated on the income. And this one also has a great feature that when the monthly payment does not cover the interest, you're only responsible for 50% of the accrued and unpaid interest. So the rest of that interest is not accruing on the loans. There's kind of a 50% is forgiven on that amount and not being added to the principal for that loan. There's no cap though on the capitalized interest, but there is a little bit of an interest break on there if your monthly payment is small enough that it's not covering the interest. So you're not going to have a lot of that negative amortization this morning on that loan. So that is one of the good features of repay. So all that being said, they're all very different, and there's not always a great answer saying what is the best repayment plan, because it does vary very differently from student to student. It was very interesting at the medical school that we did one-on-one meetings with a lot of students, and we had them go through all of these advanced calculators and looking at what the different repayment plans would look like for them, and based on how much they borrowed, what their income would look like, what field they were going into, if they were married or unmarried. It was all over the place as to which of the repayment plans would be best for them. So for each student, we'd have to go individually with them. They all wanted me to tell them at exit counseling, well, which is the best plan? And I said, well, there isn't a best plan, but there may be a best plan for you, but there's not a best plan universally for everyone. So let's look at this individually. And I'm going to show you a link to a pretty robust calculator at the end of the presentation that you could share with students that can help them look at what their individual payments will look like, because it's really an individual situation as to which plan is going to be best because of all these little nuances with them and the differences in salary and what you borrowed and what your family looks like. They're all very different, and they may be different based on this. But we're going to look at one student.
Sorry, Sean, I just wanted to pipe in real quick. This probably goes without saying, but I think all of this information is so good as part of just overall debt management. So we're talking so deeply about all these nuances, because if students have additional debt, such as private loan debt that might be at a higher rate, or credit card debt, or even a mortgage, maybe at a higher rate, the student loans, typically the guidance is to pay off the debt with the highest interest rate first, which is probably going to be credit cards or maybe even private loans. So it's always a good idea to, if folks can get their payment on their federal student loans as low as possible to manage them so that they can pay off some other more expensive debt quicker. That's also part of just overall good debt management advice too.
That's great. Yeah, and those other kinds of debts like private loan debt and Credit card debt, there's no possibility of forgiveness on those loans. Whereas when you go into some of these payment plans, even though you may be paying more interest over time, there is the option of forgiveness with some of these at the end. So let's look at Victoria, that she has $40,000 in direct loan debt, 20,000 subsidized, 20,000 unsubsidized, interest rate of 5.5%. Her income's $45,000. She's single. She's living in Massachusetts. And we're assuming that her income increases at a rate of 5% per year. So this is going to show you under each of the plans what her initial payment, what her final payment looks like, and the total amount that she pays over the life of the loan, the total that's paid in interest, and the total time in repayment. So you see standard repayment is the most expensive monthly payment for her, $434 a month throughout. It doesn't change because it's just over 10 years divided equally. But that is the least amount over time that she's paying. So that's something to consider. And everyone's a little bit different as to what their strategy is going to be. Some students will just want to pay the least amount every month. That's their goal. And they really don't care about what they pay at the end, no matter what you tell them. And some just want to pay the least over time and will make those sacrifices to make the higher payments to get to that point. And then you see under each of those payment plans, they're a little bit different over the life of the loan. Some of them start out much lower and end up much higher. You'll see graduated starts at $247. The final payments are at $741. So it does get really expensive at the end. For graduate repayment, you're making those small payments at the beginning, but at the end of the last few years of the loan, those payments can get a little bit higher than the rest of the program. So while it may be really look great at the beginning, sometimes you want to look really closely at what that final payment is going to look like and if that's going to be manageable. You can also switch between plans. So if you start out in the graduated plan and those are no longer manageable, you can go into an income-based repayment plan at that point and have that payment changed. If you don't have a partial financial hardship, Repay is always available to you as one of the income-based repayment programs. Some of the others, you have to have that partial financial hardship, so you would not really enter that program partway through the loan. And normally students will be able to qualify with the partial financial hardship earlier in their repayment plan. So right after they graduate, it's usually when they are most likely to show the partial financial hardship. It's harder to show that halfway through repayment when your income's a little bit higher. So usually we recommend if they want to get into one of those plans to start right away on those plans. So how do you designate that repayment option? You can go into the federal aid site or contact your servicer. So studentaid.gov has an income-driven repayment site, which let me go to that, show you what that looks like. Can everyone see that new screen? No.
No, just the PowerPoint. Are you sharing your
Okay.
full screen?
Yeah, let me go back and share the new screen. Can you see that?
Yep.
Okay, so this is where they would log in here with their FSA ID and they can apply for the income-driven repayment plan right on here. This is also where they can go to recertify their plan. Like I said, every year they have to go back in and recertify that and give their new income. They also have calculators here that they can look at what their new payment will be, and they can switch plans here as well, which is behind this box. They can switch between plans on here. So this is a great site. But they also alternatively can go to their servicer and do that through their servicer as well. So there are two different routes to that. Now let's talk a little bit about public service loan forgiveness. So if you have an eligible loan, which we'll be going over a second what that is, make 120 eligible loan payments, so 10 years of payments, while being employed at an eligible employer.
Sean, sorry, we can't see your PowerPoint.
I'm sorry, I thought I was sharing the screen now.
Yeah, just if you do just share screen, it should pop back and forth.
Yeah, that's what I did do, but it wasn't.
Okay.
So let me go. I'm sorry about that.
Can
you see it?
Yep, we're good.
Okay. And then after you make those qualified payments for 10 years and are employed in an eligible employer, while you're making those payments for 10 years, you receive public service loan forgiveness. So let's go over each of those details as to what that means. So what are the eligible types for public service loan forgiveness? Federal direct student loans or federal direct consolidated loans. So if you have a Perkins loan or the federal family education loan, the FEL loan, then you have to consolidate those into a direct loan consolidated. Direct consolidated student loan in order to qualify for those. So Perkins loans and FEL loans on their own do not qualify, but you can consolidate those in order to qualify for those. And all other just direct student loans do qualify for those, whether they are subsidized, unsubsidized, or grad plus. Direct student loans, all of those do. And the payment made after October 1st, 2007, so any payments made before 2007 do not qualify towards public service loan forgiveness. You must make that payment on time. So that means you have to have made that payment within 15 days of the due date. So oftentimes students are always make their payments on time, but if you make any early payments, those payments aren't considered towards those. So it is your standard monthly payment. So if you make a one-time lump sum payment of $1,000 towards the loan, that payment is not considered an eligible payment for public service loan forgiveness. So that's something to consider on that. Students often think, well, I just have to make the on time and any other payment I make is considered, but within 15 days of the due date is the important part. So it can't be earlier, it can't be later. It has to be one of those monthly payments. And it's for the full amount of the billed payments. You have to make that full amount. Again, not a one-time voluntary payment, not a partial payment. And it has to be in one of the qualified plans, which we went over, which is standard, or one of the income-driven repayment plans. And you have to make that payment while you are employed full-time at a qualified employer. Now, what is a qualified employer? A qualified employer is a government organization at any level, U.S., federal, state, local, or tribal. This includes the U.S. military, or a not-for-profit organization that are tax exempt under Section 501c3 of the Internal Revenue Code, or you're serving as a full-time AmeriCorps Peace Corps volunteer, and that also qualifies as a qualified employment for the PSLF program. There is an employer search tool that I have the link to here, and we'll be sharing all these slides with you that can help you determine if the employer qualifies for PSLF. We always recommend that students speak with the HR department at their employer to talk to them if they have information that they know if they meet one of these qualifications as well, because they often do know that. And they must also be considered an employee of the organization, not a contractor. So what that usually means is that they're receiving a W-2 from the employer, not a 1099. So they have to make sure that they are a regular employee and not at that place of employment. And so if they do make all of those 120 payments while being employed in that with an eligible loan, any amount that's left at balance left on that loan is forgiven on that. There is a great help tool here that I have linked that shows them about public service loan forgiveness. They don't need to enroll in PSLF at the beginning of making payments. So there's no way that they have to declare, I am going towards public service loan forgiveness. Basically, at the end of the program, they just have to have shown that they did that. But we always recommend that they fill out the PSLF form annually after completing a year of qualified service. And what that annual certification looks like is it's something signed off by usually the HR department at their employer that shows that they did the eligible service for that year. And the reason that we recommend that they do that yearly is because sometimes HR departments don't keep employment records for that long. So at the end of 10 years, if they have to try to go back and recreate that 10 years of employment, the HR departments may not have that information in order to be able to certify that. So even though they did do the 10 years of service, it may be more difficult to do that. They don't, again, they're not required to send this in annually, but we think it's a best practice that they do that annually. And then at the end of doing all of that service and making that payment, then you will submit one final certification that shows that you've done 120, and then you will receive the forgiveness. And also the other benefit to doing that annual certification is once you do that, then you are in the pipeline for PSLF, and they do send you yearly statements that show you how many qualified payments you've made towards PSLF while you have been doing the qualified service. And there are also certain servicers only that do PSLF, so they will switch you over to that servicer. If you wait until the end, it might delay the process a little bit more because they do have to switch your servicer and it takes a little bit longer. But if you do wait to the end, it doesn't mean that you can't receive it. It's just it might be more difficult for you to recreate that employment record. So some considerations with PSLF, and I'm going to show you a loan calculator that will show this. It's if you're choosing an income-driven repayment plan, as we showed earlier, that may mean higher costs over the life of the loan for interest. So if you make it to 8 years or 9 years with your PSLF, and then something happens, you change job and you're no longer at an eligible employer, then you have all of that extra interest accruing on the loan, and you may end up being in a more expensive situation. So that's something to consider, because there is no partial public service loan forgiveness. It's either you do the 10 years of service and receive the full loan forgiveness, or you don't receive any of the loan forgiveness, even if you're at, sadly, if you were at 9 years and 11 months service and you don't have that last month in there, they're not going to give that to you. So you may end up paying more under one of those payments if you were thinking of going in public service loan forgiveness than you may have done if you weren't thinking about it. So that's something to think about if you think your career is not going to keep you in that. One of the recommendations I used to make to students that were in the medical field, where they might have had a little bit larger income, but they may have qualified for public service loan forgiveness, was I said, put aside what those payments may have looked like for you with the larger payments. And then if for some reason you don't qualify for PSLF, you might be able to take from that savings and make a payment on your loan, so you're not paying more interest once you leave the PSLF eligible employment, so that you have that set aside for your loans for you. And let's take a look at the loan calculator. I'm probably gonna have to stop sharing. Someone let me know if you can see this.
Sean, can I ask a quick question real quick? We
Yeah.
just had a question come in. Let me just pull it up and I'll read it to you. So the student doesn't have to be at the same eligible employer for the duration of the 120 months.
They don't need to be the same employer, but all of the payments on there, they do have to be at an eligible employer. So if there's a break in service, any of the payments during that break in service don't qualify towards the public service loan forgiveness, but they could be at 3 and 4. And if they're consecutive, all of those payments will qualify. But if there's like a 1 month break in there of service between eligible employers, that one payment would not qualify. If you jump out of a qualified employer for a couple of years and then go back, those couple of year payments don't qualify for that, but the payments that you made before and any future payments that you make at the new qualified employer will count towards that. But your payments may be over time, over 10 years if you have a break in service there, but the payments that you make at the qualified employers do count towards that.
Great, because there was a couple follow-up questions, but you answered them with your answer. But let me know if anybody else has other questions and we can stop and chat real quick. Thank you, Sean.
You're welcome. So this is a pretty good student loan calculator. It's pretty robust. That here you can choose all the different types of loans that you have, your balance, your interest rate, the payments that you make, and the different repayment plans. And it shows you what your payments will look like under each of these payment plans. So right now it's looking at a $20,000 balance. And it's for someone with $30,000 gross income, that they're single, just one in the family, and it shows you under each of the different repayment plans what those payments will look like. And so these are great to look at individually for students so that they can get a visual of what their actual information looks like. It's not just an example. Because in some examples, like I said before, it may look better in the example that you're showing for that particular student. One repayment plan may look better for that, but under your unique circumstances, that may flip for what repayment plan is the best for your situation. And again, there is no best payment plan. It's all based on what your goals are and what the student's goals are towards repayment. So let me go back to the screen share. Okay, and now some resources. This is what I was talking about earlier, that NASFA recently came out with a great student loan repayment toolkit to help students who are coming out of their repayment pause and may have received guidance from exit counseling 3 years ago and now have never had to make a loan payment and don't know what to do. And so they have these great flow charts. They're all very visual. I know some of these is a little hard to read because putting it into the PowerPoint kind of squished everything. But they're great PDFs that you can share with students, and they're available all at that link that's available here. And this is one of the flow charts that's available. This is another one that shows you all of the different information about what to do, about choosing which payment plans are available to you, how to research that, what the resources are available for that. This one shows you exactly what you need to do step by step with your FSA ID, confirming your student loan servicer, logging into your servicer, selecting the payment plan for you, reviewing the dates. So it's really a great visual for students to go through on that. And all of this information, and let me just go out to that site. And I'm going to stop sharing this here. And in addition to all of these infographics, which are what I was sharing here, are all the infographics step by step. They also have social media graphics for you, short videos, YouTube videos to share with students. So there's all of these great information that NASFA compiled. And there was a whole working group of financial aid administrators from across the country that developed this to help students that are now going into repayment. But I think that it's also just great to be able to share with students during exit counseling or on social media as your students are preparing to graduate. There's a lot of really great information here that's all very visual for students. I think it's information that is shareable in ways that they like to digest this information with short videos and really graphically. And it's all free to use. As long as you're an NASFA member, you can share that with your students.
Sean, quick question.
Yeah.
Is it based on especially your experience at the medical school? Is it your experience that the repayment numbers they are using on the student loan plans app are more or less accurate?
I'm sorry. Can you
Oh,
repeat
sorry.
that?
Yep, it's a question that came in. Is
Yeah.
your experience the repayment numbers they are using on the student loan plans app, are they more or less accurate?
The
Does
students
that,
loan plans app. I'm not sure I'm
sorry,
following the question.
yeah, if you
The
wanted,
website you just showed us.
Yeah. Oh, on that calculator.
Yeah.
Yeah, that was just the default information in there. So the student would put in their actual information in there to be able to look at that. So that was just what it defaults to when you go in there. But a student
so
would
that
actually
should be
put the
pretty
actual
accurate then.
in there, and it would be very accurate.
Okay,
Based on current information. But that was just for demonstration purposes. It was just shown for default information.
Okay, so
But
I guess my question was about that, so thank you. But also when you go into, federal student aid and you use you're trying to figure out what repayment plan would be good for you. And they have on the federal site, they plug your information into all the different calculators.
Mhm.
And so I guess, I don't know if you had any experience using that during the exits. I mean, I tell students to go in and use it, but they don't report back to me.
Yeah, if they're good about putting in their information, then it should be pretty accurate. The only real unknown factor in there is what their salary is going to look like in the future. So they may not know exactly the increase that they're going to be receiving in their salary. They may change career. They may get some really good raises, and then that ends up being a much different salary. And so that's really going to change what their income-driven repayment looks like. But for most students, it is pretty accurate.
Okay, thanks.
There's another question in there, Sean, if you want to grab that. Okay, do the months that have passed since the limited PSLF waiver expired till payments begin again count towards the 120 eligible payments? So since October 31st, 2022.
So if you are a qualified employer and you're still on the payment pause, then those payments do count. But you do have to be doing the eligible payments during that period, because those pause payments are considered payments for
Right, so though, I guess, just to clarify, so the pause payments are not necessarily only part of the PSLF waiver that expired.
Right. The PSLF waiver was for past payments, so it wasn't for current like that made past payments qualified, but current payments are still qualified after the waiver. So the waiver is not allowing, if you didn't do the waiver and you had older qualified payments that would have come under the waiver, those are not going to be qualified payments anymore, but current payments that you're making are.
Great. Anybody else have any? Oh, here we go. Here's another one.
I just want to chime in here because it's what we're talking about, but I recently just had my loans forgiven under public service loan forgiveness with the waiver in place, and then the payments afterwards counting towards the new, or counting towards the 120 qualifying payments. So if you were wondering if it actually happens in practice, it took a very long time, which our staff knows about at HLS. They were following along with me from the moment I submitted the waiver, and then for the final request, it was like 5 months. But it happened eventually.
Great, congratulations.
Congratulations.
I love
Thanks.
those good news stories. And that the process is actually working, because there was a period where it wasn't working as well, but I hear it's much better now.
So we have another question there, Sean. So if a student goes back and forth between eligible and ineligible employers, does the count for the 120 payments restart?
It does not restart. But only the payments that are made while you're in eligible service count towards the 120. So any of the payments that you make while you're working at a non-qualifying employer are not counting. But any of the payments that you made while you were at a qualified employer does count. So say you're at 5 years at an eligible employer, then 2 years at an ineligible employer, and then you are another 5 years after that at an eligible employer. It's going to take you 12 years to reach the public service loan forgiveness, because only those 2 5-year periods at the eligible employer do count towards that.
Great, great. This is excellent. If anybody has any other quick questions, feel free to type them in or just take yourself off mute. Do you want to go to the question screen, Sean, just so everybody has our phone number and email? And then I think you all know how to get in touch with Sean and I individually. And then I would also recommend, I know Sean mentioned TISLA through Betsy Mayotte. She's an amazing resource, and if you're not on our listserv, we'll make sure you're all in our database, because I wrote down everybody's names. We sometimes maybe once a year, we might have Betsy Mayotte do a webinar for college administrators or families. So feel free to join in on those. And we do have some webinar recordings on our website from Betsy, which are, she's just really, if anybody knows Betsy Mayotte, she used to be at ASA, she makes all this stuff really fun and interesting, which is hard to do. And there's a good sense of humor. Yeah. What'd you say?
I say she's way funnier than I am.
So she's great. But this was really fun having everybody from Harvard get together, all the grad programs. And thank you, Mira, for bringing everybody together. This is wonderful. Anybody else have any other quick questions? Or Sean, do you have any other parting words, or Mira?
No, I just want to say thank you, everybody, for coming. I look forward to working a bit more closely with the other graduate schools. So I appreciate everyone that was able to come. And thank you again so much to Sean and Stephanie for doing this for us. We really, really appreciate it.
You're welcome. And we'll share the recording with you either probably tomorrow. And hopefully we'll see some of you maybe later this afternoon.
All right. Bye, everybody.
All right. Thanks, everybody. Have a great day. Bye.